Welcome to the next chapter of the Spreadcharts app tutorial. And this one will be very interesting because we will take a look at one of the best features of our app. Of course, I will be speaking about trading signals powered by our artificial intelligence. First of all, please understand that the trading signals are not an indication to do actual trades. We do not provide investment advice, and everything you will find under the trading signals in the app and everything I will say in this video is intended just for educational purposes. And this is not just a regulatory talk, because all of us are different. Everyone has a different risk tolerance, trading horizon, or the overall trading style. It is not possible to create a system that would fit everybody, because some opportunity that looks great to me might be totally unappealing to someone else. And therefore, the signals are not a trading system. Their only purpose is to alert you that there is some potential emerging opportunity in the markets. But it is your responsibility to do a proper analysis. We receive some questions time from time about this topic. Why the signals are not a trading system? Why you discourage people from trading according to them? Well, the point is we can easily create a trading system out of the signals. But there would not be few tens of signals, but maybe one or two signals per month. Because these are medium-term opportunities, and based on my experience, there are not many really good opportunities in the markets. As I said, maybe one or two per month. And once again, we can easily apply our own risk management, our own trading rules, and there will be one or two signals left per month. And they would not be very useful to most of you, because these would be the signals that fit our strategy, our trading style, that might be rather different from the strategy or the style many of you are using. So the signals will show you the list of potential opportunities in the markets. Many of them will not develop into tradable opportunities, but the ultimate goal of the signals is to save you time with your own analysis. Scanning tens of commodities, hundreds of futures contracts, and thousands or tens of thousands of interdelivery spread combinations, that would take you incredible amount of time. I would even say it's not possible for a human being to scan so many combinations. Luckily, that's what our model does, and it saves you a lot of time that you can commit to detailed analysis of the selected opportunities you truly like, those that fit your trading style. Another advantage is that the model, the artificial intelligence that generates the signals, is unbiased. Unlike a human being, it doesn't have a preferred market or a preferred strategy, which is great because, as I said, everyone is different, and the markets I personally like might not be suitable for you and vice versa. But our model is simply unbiased. It provides an unbiased opinion about the markets, which I think is valuable. But enough talking, let's get to the point. You may already notice that the signals are located in the main menu under this icon that is currently highlighted in blue. And the signals are organized into a grid of tiles. So let's explain on example of a single tile what each individual signal contains. So let's select, for example, this signal on outright futures, specifically on silver. In the top right corner of each tile is the ticker. There are basically two types of signals. The signals on outright futures made out of a single contract, naturally. And the second type are signals on interdelivery spreads made out of two legs, two individual contracts, one on long and the second on short. To quickly distinguish between these two types, the ticker for or the signals for outright futures have the red colored ticker, as you can see here, because there is just a single contract. And the signals on interdelivery spreads have a blue colored ticker, like you can see, for example, here on this interdelivery spread on corn. So this is a quick way to recognize the outright future signal and interdelivery spread signals. Below the ticker, there is a full description of the contract, which means the full name of the commodity, but also the expiration month and year, the specification of the actual futures contract. And there's also the direction of the signal, which is critical for outright futures, because when the signal is long, that means the model expects the price of the underlying commodity to move higher over the medium term. On the other hand, when the signal is short, that means the model expects, or probably expects, that the price of that commodity will move down in the medium term. Of course, when you have an interdelivery spread like this one, there are two legs, two individual contracts. One of them is long, the other is short. So there is the full specification of the first contract and also the second contract, including the name of the commodity, expiration month, and so on. And finally, there is a category which is just futures for outright futures and interdelivery for interdelivery spread. But the majority of the space on each tile is occupied by this chart. Well, in fact, it's just a miniature because you can actually expand the tile into a fully fledged chart. You can do so by a click on this button or by the miniature on the icon itself. So if you click on the signal, it will expand into a full-fledged interactive chart like you are used to in the charts in the app. Moreover, you will be able to see the full description because it is usually cut off when the tile is rolled up. The default view is great when you want to quickly browse through all the currently active signals and scan the market in a short time. However, the miniature chart, the thumbnail, is without axis. It's just an image, so it's intended to get a quick look into the market. And for detailed analysis, it's better to expand the tile into a full-fledged chart that is also interactive, like you are used to in the rest of the charts on spread charts. So you can hide individual time series, use the crosshair, and other features. So what do you see on the chart? Well, the top subchart is the commitments of traders' data. It's the well-known COT position index you can find in our regular charts under the charts section of the app. The middle subchart is the quick seasonality analysis. There are 5-year and 15-year averages. Once again, they are calculated the same way as the seasonal curves in our regular chart. And the blue curve is the price of the current contract, which is the same as the contract specified in the description. And finally, the bottom subchart is the signal itself. The purple curve is actually the signal strength. It cannot drop below 0, and while there is no limit to the upside, the signals are scaled in a way that we consider a signal to be valid if it gets above 1.0, which is roughly this level, as you can see here. When the signal strength is rising, that means the quality of the opportunity is improving, which means the opportunity is becoming better. On the other hand, when it is falling down, that means the opportunity is becoming worse. Just keep in mind, this is always related to the signal itself. In other words, we have a short signal on silver. In this case, it's also visible from the description in the legend of this chart. So when the purple curve goes up, that means that the likelihood of a correction on silver is increasing. The model thinks that there is a higher chance the price of silver will go down. And when the purple curve, when the strength goes down, then the model simply no longer consider the opportunity to be as good as it was when the strength was as high as here above 1.0. If we had a long signal on some commodity and the purple curve goes up, that would mean the model thinks there is a higher chance the price of that commodity will go up in the medium term. So I think it's clear by now. I would say most of you are wondering what the signal truly is and how is it calculated. Well, you are probably familiar with the seasonal signals. They are quite widespread in many platforms and apps. Even we used to have them in the Spreadcharts app. They are simple to understand, easy to calculate, but they have one major critical disadvantage. They are backward looking only, as they are calculated just from the historical data, and they completely ignore the current state of the market. I used to say that it's like driving a car just by looking into the rear view mirror. I think you would agree that's not a great idea. Relying on seasonal statistics eventually backfires because every few years there is a huge counter-seasonal move that's the cause of major losses for many traders. And the markets are also changing over the long term. Take the crude oil market as an example. The United States was a major importer of crude oil in the first decade of this century, especially from the Middle East. Then the fracking came and the new technology unlocked huge reserves of the shale oil and shale gas in the United States, and suddenly, well, not exactly suddenly, but over a few years, the US turned from the world's largest importer to the world's largest producer and one of the world's largest exporters of crude oil. And the market is still evolving. But the point is that the seasonal statistics just takes all this data and sums it up, which doesn't really make sense because the crude oil market in the first decade of this century was totally different to the crude oil market in the second decade of this century. And making trading decisions based on this historical data is simply wrong because the current market is totally different than it was back then. That's why we decided to do better. I developed a complex machine learning model that takes not just seasonality into account, but also many other types of data. It is able to make predictions in real time and adapt to the ever-changing market conditions. The only reason why there is the seasonal chart and the commitments of traders' data is because most of our users are using these two types of charts to get a quick assessment of the opportunity or the situation on a given market. The actual signal is generated from many other types of data, like price action, volatility, or the sentiment data, which means commitments of traders' data. That's especially important in the commodities markets. Of course, we include also the seasonality because it provides valuable information, but it's not the only input. We also include the information about the changes in the term structure and various valuation metrics. And the signal's value, or the signal strength, is based on the expected risk-reward of the underlying over the next 3 months. But don't think about it as expected return 3 months from now. It's much more complicated because it is very hard to mathematically describe a good trading opportunity. Imagine a situation when the price of some commodity immediately shoots higher, but then consolidates or even move down over the rest of those 3 months. On the other hand, we can have a different situation when the price slowly drifts higher over the entire 3-month period. Intuitively, we would consider both of these situations to be good opportunities. But from the statistical perspective, these are two entirely different situations, and the mathematical description of them would look entirely different. And for this reason, I devised a special algorithm that tries to quantify the true goodness of an opportunity. And that's the number my machine learning model is trying to predict. And you can find the predictions here on this subchart as the signal strength. While the best way to think about the signal and the signal strength is whether the opportunity is good right now, don't forget that the model looks for medium-term opportunities, which means that these opportunities are relevant in a matter of a few weeks up to 3 months. So these are not short-term opportunities or even long-term investments like a year from now. So keep this in mind. The actual signal's value is also scaled across commodities so that the level of 1.0 or the values above 1.0 correspond to valid opportunities, valid signals. Of course, this boundary is somewhat artificial, so we cannot say that a signal whose strength is 0.95 is bad and a signal with the strength of 1.0 is suddenly great. So there is basically some uncertainty. And this uncertainty is especially visible when you are comparing signals on different commodities. This uncertainty is also rapidly increasing with the signal strength. What I mean is that it's totally fine to compare the signals that have strength around 1.0 or below 1.0. But it doesn't make much sense comparing signals that are very strong. For example, a signal that has a strength of 1.5 and another signal with a strength of 2.0. I mean, we cannot decisively say that the signal of 1.5 is better than the signal of 2.0 because the uncertainty is simply too high. But of course, we can be sure that both these signals are quite good because they are strong. Another thing I want to explain is that the performance of the model is not the same across all the markets. And I think that makes sense because it's not the fault of the model itself, rather the input data that are not relevant for a given market. The financials are a good example because the input data like the commitments of traders or the term structure dynamics work great on physical commodities, but they are not as relevant and definitely less reliable on financial derivatives like bonds or stock indices, interest rates, and so on. Therefore, the model performs poorly on financial futures. The second difficult market or class of difficult markets are energy markets like crude oil, because these markets are under heavy geopolitical influence. There can be some sudden decision from the OPEC, Russia or another one who just flips the markets upside down, and these kind of surprises lead to unpredictable price action. In other words, it would be better to have some fundamental data and political information as an input into the model, which is something we currently do not use. We use just the data we have on spread charts that I listed a few minutes ago. And of course, there are cases when the model just fails. As I told you, these are just potential opportunities, and it's totally normal that it will not develop as the model expected. Some markets are also harder to predict than other markets, or may enter a period of worse predictability. I would also stress not to think about the model, the artificial intelligence, as some kind of a magical tool. It just takes the same data you can see on spread charts and think about it in a different way. If you're not able to predict the price of some commodity based on the data you can find on spread charts, it's probably very difficult for the model too, maybe impossible. The true strength of the model is that it can scan through thousands or tens of thousands of possible combinations and look for opportunities, which is something you cannot possibly do given the limited amount of time you have. Moreover, the signals are completely unbiased, which is also the quality that's hard to find in humans. Simply, all of us are biased in some way or the other. But let's get back to the charts. You can actually maximize as many charts as you wish and analyze the interactive charts in detail. And once you're done, you can just roll them up and get back to the default view with tiles. You can also filter the signals using this strip or window in the bottom right corner. You can filter them by category. You can select outright futures only, or just inter-delivery spreads, or all the available signals. Or you can filter them by ticker, which is quite useful when you are interested just in a specific commodity and want to find the signals for that commodity very quickly. For example, we want to show the signals just for soybean oil, so I will enter ZL, and here we are. These are the two signals that are available on soybean oil. So this is quite simple and straightforward. Finally, there is one last thing I need to clarify regarding the signal schedule. The new signals are generated once a week on Saturday. These are medium-term opportunities, and they do not emerge so often. In other words, the weekly frequency is more than sufficient. Another reason is that some of the data that serve as an input into the machine learning model is published weekly. For example, the commitments of traders data that's released on Friday's close. That's, by the way, the reason why we decided to generate new signals on Saturday. However, the existing signals are updated every day. And maybe you already noticed that on our charts, because if you maximize some signal, you can see that this is daily data, daily frequency. And I think that's very useful because you can track the quality of these opportunities basically in real time. Another essential detail is that there can be just one signal for each commodity in each category. You could already see it in our example with the soybean oil, because when I filter the signals for soybean oil, you can see there's just one signal for outright futures and one signal for inter-delivery spreads. There can be no more, and this is true for all the other commodities. And the reason is simple. When the new signals are generated on Saturday, the signal with the highest strength, the strongest signal, is selected to be added to the app. Of course, only if it is stronger than the existing signal, if there is one. If the old signal is stronger than the new one, then the old one is kept in the app. So keep in mind, always the strongest signal is selected to the app for each commodity in each category in outright futures and inter-delivery spreads. The logic behind this selection is clear. We want to make sure that you always see the best opportunity for each commodity in each category, either outright futures or inter-delivery spreads, because there are many different opportunities, even on each underlying, on each commodity, because there are many combinations of contracts. So these are competing for the title of the best opportunity on that particular underlying. So our model basically selects the strongest signal for each market in each category. And what happens with the existing signals once they become too weak? Well, if their strength drops below a certain level and stays there for a couple days, then it is dropped on Saturday. The signal is dropped from the app on Saturday when the new signals are generated. And if there is no better replacement, no signal strong enough above that certain threshold to be added in the app for that particular commodity in that category, then there's just no signal. The good example is corn right now, because if I filter the signals for corn, you can see this signal on interdelivery spread, but no signal on outright futures. So there's just no good opportunity on outright futures on corn right now. And by the way, I forgot to mention that once the new signals are generated on Saturday, we let you know on our Twitter, together with selection of a few signals there that catch our eye. There can be good opportunities from our point of view, or simply just situations that are worth your attention. Here is the example of such a tweet. We simply notify you that new signals are in the app, and also what signals caught our attention. Once again, this is not investment advice and not investment recommendation. Moreover, this is just something we compile in a matter of minutes, so we are not doing detailed analysis. These are just things that are interesting at a first sight, and you should do a detailed analysis of these market situations or of these commodities. But let's get back to spread charts. There is another thing, a useful thing I would like to show you. When you go to the dashboard, you can see the trading signals widget here. It is useful as a quick overview of the changes in the trading signal over the previous day. There are 4 columns, and the first one shows up to the 5 strongest signals on outright futures, and these signals also have to be valid. That's the reason why there are just 2 of them, because there are not enough valid signals, not more than 2 right now. These are the signals whose strength is above 1.0. The second column is basically the same, but for the interdelivery spreads. So up to 5 strongest interdelivery spreads, but currently there are just 4 valid interdelivery spread signals. The third column is very interesting and very useful because it picks the signals that recently became valid. These are the signals whose strength was previously below 1.0 but crossed this level above 1.0 over the previous day. So this is something you should watch carefully because they can highlight interesting situation, interesting opportunities, a sudden change in the quality of these signals. The final column is similar, but it is just the opposite. It shows the signals that became invalid over the previous day, which means that the signals that were previously valid but crossed the 1.0 boundary below to the area below 1.0, which means that they are no longer valid, and these opportunities are probably not as interesting as they were before. And there's always the ticker on each tile together with the name of the commodity. And in case of the outright futures, there is also direction of the signal, either long or short. This is not necessary for interdelivery spreads because we are using the so-called bull-bear notation, either bull spreads or bear spreads. And that means the signal or the speculation is always to the upside. The model always predicts whether the price of that spread would go higher. This one, for example, is a bull spread because it's long the nearer contract, and short, the more distant contract. The long short is determined by the sign before each contract. So there is no sign, which means it's plus, which is that I should buy that contract, or theoretically, hypothetically buy that contract. And here is the minus sign, which means that I would sell this particular contract. For example, this one is bear spread because it is long, the more distant contract, and short, the near contract. So we are using the same bull bear notation even in the signals themselves or across the app. So this is just a quick explanation. And you are probably interested in the color, what the color means, and also the change value in the top right corner of each tile. Well, the change is simply the difference in the strength of the signal over the previous day. We are using end-of-day data across the app, so that means the change of the strength of the signal between yesterday and the day prior to yesterday. So 1 day change in the signal's strength. And the color of the tile simply represents this change. So when the change is positive, when the signal is getting stronger, then the tile is green, and when the signal weakened over the previous day, then the tile is red. And when it is unchanged or close to zero, then the color is black. And of course, the intensity of the green or red color depends on the magnitude of the change. So this is also a simple way how to spot the signals where something is happening. And this widget is also interactive, which means that when you click on some tile, like this one, it will send you to the trading signals and highlight the selected signal, which is very useful, and it will save you some time searching for that particular signal. You can maximize the signal and analyze it in detail and see what happened over there. And we are finally coming to the end of this chapter about trading signals on spread charts. I would also recommend you to check our blog for articles about the signals, like the introductory article we published with the launch of the signals in 2019. There is basically the same information I told you in this video, but it might provide a great summary. If you click on the tag associated with trading signals on our blog, you will see all the articles we published about the signals. I would especially recommend you this one, the frequently asked questions, where we explained the way to work with the signal strength. Once again, this is just educational and hypothetical explanation, but we received many questions about the signal strength. What happens when it drops down? Does that mean the opportunity is over? And how would we personally behave if we were in that market, in that commodity or that particular spread? It's more complicated, because if the signal strength drops down, that doesn't mean the opportunity is over, because it just says that our model thinks the expected risk reward is no longer as appealing as it was back when the signal was valid. But the trend might still continue, which is usually the case, and unless there is the opposite signal, on Saturday or at some point in the future, it may still be quite interesting. But I recommend you to read the explanation. We described potential situations and how we would personally behave in those situations. But once again, this is not a recommendation. That's just educational, a few of educational examples. And that's finally all about the signals. By the way, this is a premium feature. It's part of our premium subscription on Spreadchart, but we always leave 1 or 2 signals available for free so that even the users of the free version of our app can explore them, learn to use them, and in my opinion, they will realize that the signals are able to save you incredible amount of time. That's the reason why I think it's such a powerful feature, because personally, I think it saved me thousands of hours over the past few years.